Good evening, everybody. Welcome to yet another edition of TalkIQ, our third for the semester. Certainly, we appreciate your continued support. We understand you're in the midst of midterms and finals and exams, finals for half semester classes, midterms for full semester classes. Hence we are recording the session for those of you who can make it. So hopefully you'll get a chance to catch up with all the topics we're talking about in our IQ series this spring semester. I have the absolute pleasure of welcoming Dayna Grayson from Construct Capital as our speaker for tonight. And we have a fun program for you, talking about a lot of interesting things within the domain of not just venture capital investments, but also around DEI and creating inclusive cultures and talking about what's like to be underrepresented minority or woman in the kind of a male-dominated industry. And Dayna's company, actually venture capital firm, it's quite an interesting, co-founded by both with her and her friend. And the majority of employees are also women. So quite a amazing story there, which we'll discuss. I should also mention for students, this class is PPIL approved. So please, you have to check in using the link that our great team is putting in the chat box. So be sure to check in. And at the end, I just remind you of some of the other things you need to do in regard to submitting your reflection and so on. So without further ado, let's dive right in. So Dayna, welcome to our program tonight. I appreciate your time. I know you're always busy and working on so many things. So first and foremost, I wanted to start with your kind of career story. And unlike a lot of folks that are interested in venture capital, you actually spent your entire career in venture. And also, you have been an engineer, having gone to college, studying engineering, and you have done a startup, involved with a startup yourself, and worked for software company before embarking in venture capital. So take us through some of the best lessons learned, especially leading to you launching your own firm, and especially for students who are interested in venture capital today. What advice would you share with them?
Sure. So my career into venture is I started out as an operator. I was an engineering major in undergrad and went into consulting for a couple of years, and then went into product development, product design at a tech company that then went public. And then I went to business school. And after business school, or during business school, kind of got exposed to venture capital. And I kind of think of it as I learned first and foremost kind of how to build tech companies from the bottom up, like from the code level up. And then when I went into business school, I was intrigued, the company I'd been at, it was called Blackbaud. It's still a public company, independent company today, but had been invested in by growth equity investors, more growth equity than venture, because they had bootstrapped for a long time. Nobody does that anymore. But back in those days, they had bootstrapped actually for quite a while before they actually ended up raising growth equity and going public after that. And so I had seen that process going through the IPO, the scaling, the sort of professionalizing the employee base and the management team at Blackbaud and I joined about 3 years prior to going public. And so it was a really great learning experience. Reading the S1, like going through all that. And so figured I wanted to then learn kind of business building from the other side, more from the financial side, from the top down, from the leadership side. And I was sort of indifferent. I was either going to start a company, join another rapidly growing startup, but more on the business development or sales or some other aspect, but ended up meeting a venture capital firm in Boston, thought I would go there for a couple of years, and ended up, being in venture ever since. And so I was at an early stage venture capital fund in Boston for about 6 years. I then was recruited to a larger platform, which, we can talk about small versus large and, different products and why there are different products, if you will, in the venture market. But I went to a large platform in venture called NEA and was there as a partner for about 7 years and invested in a number of things. 20 companies overall. I was on the board of 12 companies when I left NEA to jump off and do my own fund, and really kind of saw through those 7 years an opportunity developing in the industrial software space. Increasingly, I've made a couple of investments around industrial tech or industrial software, made a few more, and then really from 2015 to 2019, everything I was doing was in and around the industrial sector, and really saw a hole in the market for people that then understood early stage tech investing, partnering with entrepreneurs, navigating business models, building teams in and around what we have now called at Construct Capital foundational industries, everything from industrial to supply chain to mobility and delivery. And our whole fund is now focused on that. So that was the kind of path to where I am today.
So,
and for you kids, yeah, sorry, go ahead.
No, go ahead. I was about to remind you about the second part of the question.
Second part of the question, I think, was, what advice would you give to folks in your position, now in business school, now in school, thinking about maybe careers in venture or startups? I would say, that was my path, being in operating, having a technical background, and then being able to apply that. It was very helpful, especially in the more technical side of investing, and that I understood, and I would say maybe past tense, sometimes present tense, understand the technical sides and the engineering sides of the companies that I invest in. But realistically, like, great venture capitalists come from all different backgrounds. Some come from operating, some come from years of operating, some come from being founders and CEOs. Others come from, financial backgrounds, investment banking or consulting sometimes, journalists, some great journalists have made great venture capitalists. So there's really no exact pattern. I think it's more just this curiosity to learn. And that's perhaps why journalists sometimes make great venture capitalists, because they have this, that is their job, is to break down and understand and tell the story of whatever it is that they're covering. But you take it a step further in venture, and it's really to dive in and understand the dynamics of the company and the founders and how it all fits together to make something great, not just something logical. That is that sort of insatiable curiosity and the desire to kind of break things down and build them back up in your own mind, not physically break them down, build them back up. That I think makes great venture capitalists.
It's interesting. You talked about, deep curiosity. That's a theme that's coming back time and again in every conversation we have had thus far with your peer venture capitalists. So I hope for those who are going to watch this and going to watch the prior conversation, they understand if three people say the same exact thing, there must be absolute truth to it for sure. And I should have mentioned to the attendees that at the end of the session, as always, there's a prize for best question asked. So feel free to submit your questions throughout. I'll interweave them into our conversation. And the book that we have selected as a book giveaway today is the book recommended by Dayna, VC, History of Venture Capital. And the link to Amazon is in the chat box for those of you interested. But Dayna, going back to our conversation, you have picked a very interesting theme for Construct Capital. It's you see a lot of firms chasing the latest hot thing, whether it's blockchain or AI or what have you. But you have stuck to a very well-defined theme that you don't hear much about often, and you raised a successful fund around it too. Take us through that journey, especially in regard to you having to educate limited partner investors that you're not, chasing NFTs, you're chasing something that seems quite complex and some might say even boring. And yet you're staking a claim in the ground. There's a lot of opportunities there. So take us through your thought process in developing the theme and your interaction with investors and opportunities you see for investments coming from entrepreneurs.
Absolutely. So, I think it is, maybe going back to the journalist and the writing thing, it's doing what you know. And I think there is a lot to be said for whether it's early stage investing or whether it's lead investing, whether it's, pre-seed kind of spray and pray investing, whether it's NFTs, whether it's Supply chain, investing around themes and a strategy just consistently. If you think about entrepreneurship, it's like the one thing that's eternal. Like, what's the one thing in the world that I think will always be here? It will be entrepreneurship on some level in some parts of the world. Somewhere there will always be new companies and new entrepreneurs setting out to start something new. And so when you think about venture capitalist and how I approach it, it's just, I stick to being an early stage hands-on investor. We invest for reasonable sized ownership, go on the board if there's a board. We like to help. We're not active in the sense that we're not operating our companies. We don't reach over the steering wheel, as I say, but we do like to know what's going on in the companies, and so that we can help. And if we're not helping, then we don't deserve to know what's going on in the companies. So we just do that over and over again. And I think there's a very large part of the GDP that has not been software enabled. So software, certainly, I think everybody subscribes to the notion now that software is eating the world. Everything's going to become software enabled, but there's a lot of challenges in the supply chain space, for example, in the manufacturing space, and to making software a difference maker in those markets. It's not obvious sometimes that anything needs to change. We have a company, working in the freight rail space. Like, nothing's changed in freight rail since like the 1800s, legitimately. So the question is like, why does it need to change? Well, the why it needs to change is because it can. Like, you can see so much more visibility into where products are, how they're moving, when they'll arrive, when therefore, trucks need to be there to pick them up. All of these things cut out a lot of inefficiencies in the market. And yes, it works the other way, but imagine if it was 50% more productive. I think that's a very easy world to imagine right now, given what we've seen in supply chain in the last year. Now, when you ask about crypto and NFTs, we think all the time about how that, fintech instrument, if you will affect the areas where we're investing. It's not quite obvious yet. By the way, I don't think it's quite obvious where it'll affect a lot of other spaces either. Most of the funds that I think have done well are actually like holding coins, versus doing a lot of equity investing or leveraging it in other ways. We're not going to be just investing in coins. So I can't say we're gonna pursue that part of the market, but we're, again, fulfilling the sort of like intellectual curiosity, always figuring out like how you can do things more efficiently. If there is something to be done with NFTs in the supply chain, we'll definitely pursue it, but it's not part of our strategy today.
And to clarify, you invest in seed stage ventures. So how do you, define seed stage versus idea stage in such a complicated industry where you're fighting against a lot of established interests and legacy systems that resist change with all their might?
Yeah, sure. Well, for that reason, because it is much more than the idea, I'll say first and foremost, we're investing in people that really understand the markets they're going after, and couple that with just a willingness and, ability to make things happen, regardless of whatever space it is. You just know those people, you understand it when you see it, and they say, if they're coming out of industry or if they're coming out of a tech company and turning their attention to these industries, that often is more of the profile that we see, that we get excited about. Somebody coming out of, an Uber, for example. My co-founder here at Construct, Rachel Holt, was at Uber for many years. So we see a lot of people coming out of Uber, starting companies. We love that profile because they're very operationally intensive, analytical, not just at Uber, but Stripe or, number of tech companies. And then if they're turning their attention to some of these industrial world companies, we know they've seen hyper growth before. We know they've been able to scale teams rapidly. They've been able to disrupt incumbents before. They've been, in the case of Uber, been able to do things that really looked impossible to be done, revamping a taxi industry. Like who would ever think of doing that? And yet that, they grabbed a hold of technology, namely mobile technology, mobile platforms, to make it happen at the time. So we look for wedges of, technology as well. And like, what is it that what's the why now as to why this industry should finally change, not just could finally change, but really should. So oftentimes we do like to see, in addition to a great founder, some proof of adoption, some proof of product market fit, even at a small scale, just to see some proof that there's some evidence of a willingness and a timeliness for something to change at that time.
Your answer begs the question, and that is, to what extent do you value prior experience in the industry the entrepreneurs are trying to disrupt? I mean, you mentioned, rails. Are you looking for someone who has spent a couple of years in the rail industry as either founder or co-founder, or is that less of a concern because the right entrepreneurs will disrupt any industry regardless?
I think it's a little bit more of the latter. What we're really looking for is a pattern and a history of having something to prove and being able to iterate and go quickly and build, boldly, to put it, for lack of a better word, to be able to hire, to be able to put the resources, not just bring them to bear, because we can bring the resources to bear, but put the resources that you have to good use to produce value. That's really what we're looking for. So it could be a super scale, you super scaled a team, you used resources you didn't, you leveraged resources beyond their means in whatever capacity it was. It could be in a large company and you made it, 10x larger. It could be in a small project where you just scrapped together and made something happen that would have otherwise not been able to happen. We want to see that kind of pattern of success.
So you've been in venture a long while, venture capital, a long while, especially in senior leadership role, including partner at NEA. Now, looking back at all the companies you invested in, what heuristics or lessons can you share about both successful and unsuccessful investments that you feel like are repeatable in the past? You can codify those into rules.
Mm-hmm.
Kind of a Bessemer anti-portfolio.
Yeah. I mean, I would say that I would say that codifying it into rules is, both the entrepreneurs that I really think have, dramatically out-succeeded others, or outperformed others, as well as the entrepreneurs that we didn't invest in, that I've seen outperform others. The commonality was just one, being really close to the problem, and kind of micromanaging the problem, not initially hiring a team, but doing things that some other venture capitalists have coined this, of kind of doing things that don't scale at first, but being really in touch with the service or the product and the problem that you're trying to solve. So, I originally talked to a guy named Bom Kim, who started Coupang. I didn't know anything about Korea, and I didn't end up investing in the company, but he was at HBS at the time and was thinking of dropping out to take, to pursue this idea. And what he told me at the time is he was sort of staying up overnight and researching what was selling at the time. Coupang's original incarnation was more of a Groupon or Living Social for Korea. And so he was really studying Living Social and Groupon and every offer that they were putting out overnight and documenting it, rebuilding his own spreadsheet and seeing what worked and what didn't work, and organically kind of building up, algorithm for how to piece together on-demand sales. And I was like, that's really smart. No one's going to just hand you this data. You can't just research things online. You have to be able to scrappily build your own models and your own understanding of the market and being on the front lines of that. And that just spoke volumes. And I've seen this over and over again with other entrepreneurs where they're just so deep in the weeds of the problem that they have this innate feel for how to solve it. And they're not afraid to just dive right in themselves. And sometimes that means building the initial versions of the product. Sometimes it just means building the initial model. Sometimes it just means an initial data set or data gathering that that really uncovers the problem, but they really have their hands in it.
And you put an interesting qualifier there that you don't mind if those activities are non-scalable. That at least if they go towards solving the problem and being close to the customer and the solution, those you would be okay with that. You don't necessarily see it as a negative thing if it's not scalable at that stage. Am I right?
Right. I mean, what you see is sort of like, okay, on one hand, you really know the problem, you've gotten in and you've really been able to solve it in a way that has produced some value for some limited set of people or customers. And then on the other hand, like we can help see, they can see how big that market potentially is if you were to bridge those two things. But if you don't have those two things, you don't have a big opportunity. You can have a small modicum of success and no market, and then you just have a small company or an idea. You can have a great big market, and then, and that's also a pitfall that a lot of folks make, is they just think they've ideated something that will eventually sell to this product or this market that might be huge, but they actually haven't found the solution yet. And so you need to both find a solution on some small scale and go after a big market. And then the capital and the technology and the team and everything else is just a way of bridging those two things.
Now, obviously, investing in early stage is a combination of art and science. It's not, it's hard to quantify and make some of these metrics that you measure tangible. So you have to go with a gut feeling at the end of the day anyway. So along those lines, how do you measure product market fit, knowing that more often than not, it's hard to determine that with high degree of accuracy? We could only do it in retrospect, but at the moment, it's more often than not seems a bit challenging. So how do you go about managing the art part? How you seeing how the team meshes well, and if whether they are even on track on regard to product market fit and dimensions like that.
Mm-hmm. Well, you can get, some sense of like, is someone liking what they've built? Sometimes that means you have to just go talk to the initial set of customers and understand if they've liked what they've built. You can experience the product yourself. Other times, if it's like a consumer company, and we don't do a ton of consumer, you can like see it in the metrics, right? Even if they're small, you can see the viral effect starting to grow. But what I really look for is rapid iteration cycles too, of, you want founders to take feedback, listen to new ideas, not necessarily from us, from the market, and then evaluate them and pursue them or drop them quickly, right? And so, we were talking to a founder recently who, in addition to what they were thinking of doing, we had seen this other sort of phenomenon going on in the supply chain market. And we said, by the way, we've seen this other phenomenon going on in the market. I won't bore you with all the details. And then, 2 days later, he said, wow, like we pulled that thread a little bit because we already had the customers to do it with. And that is a big problem. And now we're just doing a test of this, like it's not even a product, but he's like testing it already with the customers that he has, like in 2 days, just quickly, like throwing against the wall and seeing if it has any legs to it, if it can walk. So that's the type of like iteration and market testing that we love to see in founders.
So it's a combination of actual action plus, some of the other things you talked about. Super interesting. Now, going back to a question I asked earlier about, traction with limited partners. I mean, in essence, launching a venture fund is being entrepreneur. You have to literally go through the whole entire process of defining the theme and, talking to a lot of investors, convincing them to give you funds to invest on their behalf, and so on and so forth. Now, again, the theme of Construct Capital it's different than many others, and it's very well focused, but at the same token, is not typical of what we see. So take us through that journey in regard to, if you had to educate any, if you had to educate the limited partners first before you can even talk about the merits of investing in Construct Capital. And obviously fundraising is always an uphill battle. So any lessons learned would be appreciated.
Yeah, Yeah, I mean, I think that the thing to keep in mind is, with some exceptions, some investors or LPs, limited partners, are investors as well as sort of LPs. But by and large, like when I talk to most, endowments, foundations, by their own label, they call themselves capital allocators. And so capital allocation is very different than investing. Investing is, sort of what I've just described, like seeing something, kind of imagining what it could be, listening to founders, putting the vision together, or, investing at the later stages might be really metrics analysis, hands-on diligence, et cetera. Capital allocation is really backing others to do those things. And so they allocate capital on different criteria. A lot of it is on, your track record. Have you done what you say you want to do in the future? Have you done something already like that has produced returns? That's why it's oftentimes for limited partners easier to come in and invest in fund 2 of Construct Capital or fund 3 of Construct Capital versus fund 1. It can be very hard to evaluate the first fund because they don't know that any of it will work. They don't know that what you were doing at the last firm you were at will translate, even if you have a great track record. Sometimes folks don't have a track record yet, so they don't know how to evaluate that. It's very hard, but that's why I think if you do have, for us, it was very much sort of building on something I'd been doing at in my case, NEA, and something my partner Rachel had been doing at Uber, in addition to kind of operating and running the Uber Rides business at scale. She was also doing an incubator there and had done some seed investing, and we had worked together prior. That was also very important to LPs to see that the team that they're putting money behind can make decisions effectively and make good decisions effectively. That's really the whole name of the game in investing. It's not just seeing the company, but being willing and, or being able to like act quickly and decide to invest, especially in limited time and resources that we have in venture today. So, it's sort of all, and to layer a difficulty onto all of that is like, you can find those two things, LPs who want to invest in you and LPs who like what you're going after and the team and everything else. And yet it could still be the wrong time for them. They may not have room and whatever pool of capital it is that they're putting to work to add a new fund, because they invest in funds vintage after vintage oftentimes. And if you have a set of 10 funds that you back and they come back to you every 2 years with a new fund, you kind of plan your capital allocation strategy that way. And sometimes it doesn't allow for adding new funds to the mix. So there's a lot of things that you have to kind of put together. Now, the flip side is there's a lot of capital in the world. So if you're patient and diligent enough and can sort of talk to enough LPs and target your work effectively and finding the alignment of those things, that's sort of what we did, and it ended up working out as we put our first fund together.
Now, one could argue that the venture business as a whole is kind of changed into more of an option play than anything else, because cost of doing business have gone down. People can do proof of concept quickly, in theory, and also the cycles have become much faster. To what extent do you agree or disagree with that thought? And again, from your perspective, past experience and now at Construct Capital, how have you seen the industry as a whole change over the past decade or two?
Well, conventional wisdom in venture, in firms that started in the 90s or 70s or 80s, was that it was a cottage industry, and it was sort of rolling up your sleeves, helping the entrepreneurs, much like we do still today, but that it may not scale, and that just putting more money behind companies didn't always make them win or make them better. And for bad or for good, like I think the data shows otherwise. That I think the data has shown, with the number of unicorns we have today, number of unicorns when that first term was dubbed, it was what, 2014 or something, and it was like 80 unicorns, and that means a company valued at greater than $1 billion. And that seems like ridiculous, $80 billion of market cap in private companies. that were still growing and hadn't gone public, coming out, 10 years after the dot-com kind of recovery, just seemed impossible. And now I think there's over 1,000. So what happened in between there is that capital makes up for a lot of flaws. Like you can, for great entrepreneurs or even sometimes reasonable entrepreneurs, if you've gotten to that point, and you do have to get to a point before you can raise a lot of capital, I think the data has shown that if, with some certain degree of failure for sure, but for a number of companies that maybe wouldn't have succeeded, except that they had more capital in place to then figure things out and scale the team and iterate and grow, that was a big difference maker in helping them succeed. So I'd like to subscribe, and certainly I am an investor as a smaller fund in getting those companies started, but I can't, with reasonable degree of confidence, tell companies that are at the Series C or the Series D that they shouldn't raise $100 million versus $25 million if they were given the option, because within, some level of dilution, the $100 million is always going to be better if you want to build a multi-billion-dollar company. Now that's a much riskier stance, and you have to know what you're getting into. You do need to sort of go big or go home. But if you have that option, you should take more capital. And I think that's the thing that has changed in venture in the last 5 years. And it's an aggressive stance to take, but if you're raising venture and you want to build a big disruptive company and you've gotten to that point, I can't tell someone not to do it.
There's an old saying in aviation, you can never run out of altitude. The more altitude, the better. So I guess in venture, the more cash, you can never run out of.
Right. If you don't run out of money. I mean, entrepreneurs, as CEOs, I tell CEOs, it's like your main job is to not run out of money. Like whether you're raising venture, whether you're pitch dropping, whatever you're doing, the music stops when you're out of money. So you can take different paths, you can get profitable, you can raise venture, but that is your job as a CEO.
Well, Dayna, I'm going to take a slide. I'm going to come back to this question of culture, large firm, a small firm, all women-led firm and all. But I want to take a slight detour since we are on this topic of macro trends. Obviously, we have been through a 10 plus year, 10, 15 year bull run, a fantastic run. Some argue that, you could have been a mediocre venture capitalist and you still would have had, great returns nonetheless. But now we are finally getting into certain headwinds, markets, some events are happening around the world that certainly would affect growth in general. How do you see the market, just venture business as a whole evolving in response to those? Do you see there more discipline coming back to this? Do you feel entrepreneurs are becoming a bit more, even more sophisticated in managing all this risk? Or do you feel like there is still enough capital to compensate for some of the mistakes, which I love the way you put it, that it's indeed very true.
I think it's too early to really say. I think the public markets, we all see it, right? Like that there's like 80 tech stocks or more that have contracted more than 60% already this year. And that's like not a minor deal, but it takes a while to kind of trickle down into private company financings, because unlike public markets that are being revalued every day, private companies are revalued every year or whenever they raise their next round. And so it's a moment in time, a little bit more for private companies. And so if you're raising money on, right now, maybe you're feeling it more. Some of our companies are not raising, and most of our companies are not raising money right now. So they're putting one foot in front of the other and, maybe being a little bit more realistic. I wouldn't say pessimistic. I'd say realistic about, having more time between when they raised 2 rounds of capital. Over the past 2 years, it just became frenzied. You would raise capital 1 month, and then 3 months later you'd raise again. That used to have 18 months in between. And so I think that's, oh, did we pause? Okay, are we back?
Yes, you are
I
here.
think, can you
Dayna,
hear
we
me?
have you. Yeah, we have your audio, video perfectly.
Okay, great. And so I think, I think in some ways, depending on which side of the coin you're on there, if you want to raise every 3 months or every 6 months, that's going to be harder. But if you want to kind of finance your companies the right way and then, take time to build in between, then perhaps nothing much will change.
Great, great. Now switching back to the kind of a question around culture and how you run the business. Obviously, NEA was a massive company and managing billions of dollars, and with that comes certain privileges in terms of resources. But now you're running a smaller fund, a lot more entrepreneurial. And you also have to fight for deals just like everyone else. So how do you differentiate and stand out amongst the crowd? What practices do you advocate for that make you a lot more agile in terms of winning the deals? And this includes deal cycle time. On average, what's the timeline that when I walk into the office and I pitch you by the time I get a check, and how does change from your NEA days, if any?
Well, I think it's really incumbent upon entrepreneurs to know who they're pitching, to know why and who they would go to raise money from. And even at NEA or my prior firm to that, like when I was really looking for something, I was really focused on it, and I found that entrepreneur, found that idea, it was a perfect fit, and I could move very quickly. And the same thing happens today at Construct, but we've really created the firm with that in mind. Like we talk about openly what we're focused on. We talk about openly what we're looking for. You already talked about it here today: supply chain, manufacturing, mobility, delivery, kind of software building inside of some of the foundational industries of our economy. And so if we have on a deeper level, if we're looking for something around fintech in trucking, for example, we haven't made an investment there. We've looked at it in the past. And we then sort of canvas a number of companies, try to network into entrepreneurs doing things in that space. We come in prepared to find something. We've done our diligence ahead of time. And so that when you meet an entrepreneur, the diligence process is much more around their model and what they've done and who they are. And we can take out all of the market research and environmental research around the idea, because we've already done that work. And so that's sometimes, if you're a large multi-stage generalist firm, that's another 30 or 40% of your work, and it just prevents you from moving as agilely. And that's what I think, I think that's what every successful venture capitalist here and on out is really going to have to do. Focus, know what they're looking for, not have the whole theory of the case, because that's what entrepreneurs do, but come in with a prepared point of view, and so that you can be ready to act and ready to invest. So for us, that could be, from meeting an entrepreneur to investing. We can make up our mind really quickly if it's in a space area we're really excited about.
I see. So, and in terms of culture, you have worked at a number of firms, large, small, medium size, and your own. Share some of the best practices that you've seen work time and again, and especially when it comes to fostering diversity, a diversity in all its dimensionalities, thoughts and backgrounds and gender and so on and so forth. Because obviously there's a lot of literature that shows the value of diversity in bringing about the best of innovation, but some firms seem to do a better job at it than others. So we'd be interested in hearing your thoughts, given the perspective and vantage point that you have.
Yeah, I mean, I think, so I think at the end of the day with venture, it is, if you can structure it right, it is very much a sort of, I hate the word meritocracy, but it's a sales job, so it's not necessarily who's the smartest person in the room, but who's the most prepared and who can win the opportunity. It's a competitive field, but if you kind of level the playing field in terms of going after specific areas of interest or going after specific entrepreneurial networks, there's other levers that have nothing to do with the diversity angle or anything else, that if you're focused and if you're driven in those areas. I think the beautiful thing about entrepreneurship is entrepreneurs, like we're working really hard day in and day out. They want somebody who really understands their challenges, who can be additive to what they're doing, and that will rank so much more highly than anything else in terms of background. At least in my experience, that's what I've seen, whether it's entrepreneurs I'm working with or entrepreneurs are working with others. I have rarely heard that an entrepreneur has picked an investor based on anything other than the quality and help that they think they will get from that person. And so that is a great equalizer. And I hope, most venture capital firms embrace that. I think they realize it, but maybe embrace it in different ways and maybe kind of become a product of their own upbringing sometimes. And going back to what I said before about venture being a largely cottage industry, it wasn't for years, and maybe still is at a lot of firms, isn't like a consulting firm where they hire a class of analysts every year and they go out and canvas the landscape for people with, from many different backgrounds and have an official hiring process, because they may just bring on one person every couple of years. And so when you're doing that, it's unfortunately easy to just hire from your own networks and not lift your head up and do a comprehensive search. And it is when you're doing that when you do those comprehensive searches, when you can control for seeing all sorts of candidates and making sure you're being more equitable in your sourcing practices. So I think that's the problem that kind of built on itself, but it's easy to solve if you've got that bigger funnel, I think, at the top.
Oh, interesting. Obviously, relatively speaking, the industry has come a long way from, in regard to inclusion of women, but still you're far away from reaching any level of parity. And yet you've been quite involved in trying to level the playing field, which we certainly appreciate and applaud your efforts in that regard. Now, you pointed something quite important, and a fact that hiring in venture, it's quite opportunistic, and it's a matter of not just talent, but right time, right place. So for those students interested in pursuing venture, you already established that they could come from a variety of different backgrounds, and that's not a hindrance. But what other qualifications, characteristics would you advocate for them in developing? And also alternative paths that, even though someone is interested in venture, there might not be a job in right now, but should they work for a large company? Should they do consulting? Should they work for a startup? Which of those venues would increase the odds of breaking into venture for one's career?
I do think being in those fast-paced environments, like seeing success on the other side, I think, to that end, I think I think one of the most perfect training grounds, it doesn't mean you'll necessarily get into venture or that you will be good at venture, but the skill set that I think is most helpful on a day-to-day basis in venture is probably a combination of banking, really, strong analytic, high pressured environments where you have to form a point of view on very little data, turn it around quickly, and present it in the best possible way, in a salesy-like way, is really good trading ground. And then if you've done that, plus like an operating role or something more technical in a more technical company, I think that's a great skill set to have. Again, it doesn't necessarily mean you'll be networked with the right people to get into venture, but I think it does give you a perspective coupled with that third leg on the stool, which is like your intellectual curiosity and desire to see companies be created and support entrepreneurs in doing that. Those would be the three combinations that I would think would be a really great combo in making you can't make you a great investor, but can make you kind of equipped with all the skills to evaluate and win opportunities.
Now, a question is specific to my engineering students. As you well know, I teach both at the business school and in the engineering school. Now, all my engineering students are going to be working for in a tech role. So, the few of them would go to consulting or other jobs that are typical, venue for MBAs. So for the engineers, and given the fact you have been an engineer yourself in college, what roles within tech would you advocate them to pursue that, again, would increase the odds? Do you want them to do software engineering and then become project managers or PMs, or some other roles, or join a startup? Any insight would be appreciated.
Yeah, I think product roles are great. I think finance roles are great. If they're sort of hands-on finance, strategic finance roles, inside the CFO's office, but doing something, financial planning, modeling, understanding the business. Sales can be great, frankly, if you're really hands-on and technical sales and really kind of putting yourself in the middle of, driving revenue at the company. I would probably say those three.
Great. Now, knowing you since your NEA days, I was always impressed with your attention to detail. And it's evident even just looking at the Construct Capital website, kind of the general look and feel, and how you run, the ship, so to speak. So give us some insight into how do you define, as a co-founder now, you can actually define the culture of the firm from the ground up, from day one, and inject it into its DNA. Take us through that process. We all read about it, but we'd love to hear from someone actually doing it, right now. What practices you incorporate to ensure that the culture stays innovative, inclusive, and all those good things that I know you're amazing for.
Well, we do have this, motto that we want to be able to invest as quickly and swiftly as an angel firm, but do the diligence and run the processes and come with prepared minds at the same level that you would at a multi-stage, Sequoia or NEA or Andreessen. So that's, tough to pull off. What that requires is for us to really focus so that we can constantly be digging deeper into what's going on in supply chain, staying relevant there, and it is changing. We never thought supply chain would change as dramatically and on a daily basis as it does right now. But stay as relevant. We want to be experts in those areas and understand what it takes to kind of break through and convince buyers to try something new. And then if we find great ideas, then we understand how likely it is that they can bring it to market. And so, we're constantly digging deeper into our research and our points of view at the firm. And then, and so in terms of building a culture, we try to architect the team so that each one of our team members can take on different points of view and go deep into that research, and then start to build relationships with either portfolio company entrepreneurs that are already in our portfolio, or new entrepreneurs with those perspectives. And everyone sort of works as a team right now to go after things together. There's no attribution. Rachel and I don't look at the firm as sort of your deal, my deal. We look at it as, we're a small firm, we're going to throw everything at every great opportunity that we invest in to help it become successful. So we're all building this sort of institutional knowledge of these spaces together, because we don't believe in sort of expertise built over years that you continue to rely on. In venture, everything changes frequently, so you always have to be able to just sort of disrupt the way you've thought about things in the past. So we're constantly kind of adding to that.
Now, as a small firm, first and foremost, I should say, I really appreciate the fact that you keep referring to building all these intellectual assets within the firm, the research and understanding the industry. I think that's, for a firm at your level, is quite admirable. Now, in terms of hiring, though, you have a lot less room to maneuver when it comes to hiring, in a sense that you really want to get it right. You can't afford to, hire the wrong person and, go through the process yet again. What are the, less tangible metrics you use engaging one person's fit within the, Construct Capital's culture and how they should perform? Do you use any tricks or anything that you can share with us? Any, any lessons learned? I think would go a long way in educating us about the process you specifically deploy at Construct Capital.
Yeah, I'll say, first of all, we're a young firm and we're still figuring out all those dimensions. And I do think kind of building your processes on the cultural side or something that'll be living and breathing, and we will settle into that over the next year, probably or so at the firm. But we look for people that are have strengths on the analytical side and strengths on the points of view that we're going after, and then strengths in sort of also being able to relate to be able to sell entrepreneurs. This venture is a sales and service job at the end of the day. So you have to be able to win entrepreneurs over and then continue to win their acclaim, if you will. So like their willingness to work with you. We always want to be the people they call first if something good, bad, or indifferent is happening. And so you have to earn that position with entrepreneurs. You're not just given it. You're given that, you earn it based on the work and the service that you help them with. So we look for that sort of service mindset, hustle, resourcefulness, and depth of sort of research and analytics.
You alluded to something interesting that when it comes to general way you operate, and including compensation, it's not like you're saying, oh, my deal versus your deal, and because it's my deal, I'm gonna, I'm entitled to a lot more. How do you foster that kind of mindset from the get-go, where people are not just being too married to their own ideas or ideas they bring in? It's more like a collegial and collective effort.
Right. Well, I mean, if you're going to have shared responsibility for it, and that it's not going to be just on your track record or her track record or his track record, it's incumbent upon you to make sure that it's going to succeed, that you're equally as excited about seeing it succeed as anything else in the portfolio.
Now, Dayna, well, certainly, I know you're a HBS graduate, but I certainly hope, should you ever have an opening at the firm, you would consider students from Columbia as well. But speaking of, being on top of things and educating, you have a lot on your plate, and I know, but yet you find time to, be quite deeply entrenched into a variety of different industries. So how do you manage your time in general? How do you, get to do all the things that you do? What's your secret?
I don't know. I think what's really actually been great over the past 2 years, which is funny to say now, is I never thought this would be something beneficial in venture, but the pandemic kind of opened my eyes to this, is that, not traveling as much, I miss meeting entrepreneurs regularly, and face to face, but it helps you focus on like which opportunities you really want to dig in on and focus in on, and then going and meeting those entrepreneurs in person versus kind of, you can get in a scheduling sort of cycle of all you're doing is taking meetings and you never have time to really think about like what you're taking. And so the pandemic has actually been really helpful in focusing that way.
So would you envision that, happening moving forward, or would there be pressure at some point to get on the road again? Which by the way, I totally agree with you. I don't miss travel. I don't miss travel much.
I don't miss travel much either, but I think I'll be much more intentional about when I travel and for what, and how qualified, how excited I am about things. And it can happen very quickly. I met an entrepreneur this week, actually last Friday for the first time, and we're already deciding to invest, and I was able to meet them in person this week. So when we're really focused and things align, we can move really quickly.
Talk about moving at angel network speed.
Yeah.
In a few remaining questions, I want to ask some rapid fire questions, and hopefully we can, go through as many of these as possible. In general, looking back at your own career, what do you wish you would have known when you started your journey in venture that would have helped you save time, headache, stress, and so on?
I mean, frankly, what I was just saying, I mean, I would say it again as an answer to this question is that, staying heads down and sort of, people, resisting the FOMO is a real secret power, So in the first part of my career, and I was given good advice at that point because I was just, a couple years into my career, I was, young, I hadn't done much. I didn't have sort of name recognition nationally, right? So, or locally or anything. I had just only been a product manager and gone to business school. So I did do a lot of networking and getting to know people and getting my name out there and stuff like that. That's I think important. But soon thereafter, you can get, you have to follow it up with sort of, what did you do? What's your research? Not your research, but what's your investment thesis? What are you good at? What do entrepreneurs think of working with you? So, digging in quickly and working with entrepreneurs and having that reinforce your thesis, I think is really important. And doing less of just sort of that, the FOMO chasing.
Which is very important, and which is, by the way, is not easy to do whatsoever. I totally agree with that. Now, being a venture capitalist, you have a very long time horizon. You're thinking about the next 5, 7, 10 years. What trends do you see on the horizon that should be on our students' radars in regard to, transformational changes, how the industry operates, or how venture or technology or startups will operate?
That's a good question. I mean, I do think, I don't know where this whole hybrid, remote, in-person stuff will land, but I think it's going to be, I think it would be very hard to build your career in a totally remote setting. I also think it'd be hard to build your career in a weirdly hybrid setting. So, I would make, I guess, to the students here, who are thinking of taking jobs, of course, in the near future, think about places that you might have to adjust kind of how you think about culture and how you think about like mentorship. And those are real questions that I would ask during the interview process of how will I be mentored? Not will I be mentored or by whom, but how does that actually happen in a hybrid or remote setting? That could be very isolating. I remember this was years ago, but when I came out of college, I had an offer to go to IBM, and IBM was one of the first companies to really pursue remote, that they changed their whole business to remote a long time ago, like in the 90s. And so, and they offered me the job, and they said, you'll work at home. And I was like, as a 22-year-old coming out of college, I couldn't, did it freeze? Are you there?
No, you're here.
Okay. Coming out of college, I couldn't imagine anything worse than like being at home all day by myself. So, and it was for that reason of like, how would I get to know anyone? And, I didn't take the job, so I'm sure IBM had its own ways and it could have been great, but these are very relevant questions in today's environment.
All right, we are almost at the top of the hour, and just wanted to once again thank you for your time and sharing of your wisdom with our students live and those who's going to watch the recordings afterwards. And for those in attendance, please don't forget your PPIL check-in link and the reflection form link that are in the chat box that you can certainly use. So Dayna, thanks again for your time. It's always such a pleasure to chat with you, and I really appreciate your fresh perspective on things and your candor and the can-do attitude. I attribute that not just to your engineering training, but also the way you are. And I certainly look forward to our future interactions with you and Columbia, and I wish you a pleasant evening. So thanks again for your time. Thank you, everybody.